Great. So once again, today's section, we are going to look at the continuation of the IAS 12 where we reached last time. So let's continue. IAS 12 talks about income tax. IAS 12 talks about income tax. IAS 12 talks about income tax. Good. So income tax. We said that we said that IAS 12 specifically talks about how we arrive at the income tax expense in the company's account. Income tax what? Expense in the company's financial statement. So we said that the income tax expense is made up of three items. What are they? Current year tax, under or over, and deferred tax. So if you put these three together, that is it. So we said that the C represent what? The current year tax. So much. I also call it the corporate tax for the year. Corporate tax provision. They mean the same thing. The U represents what? Under or over tax provision. Good. So much. Under you add. Over you subtract. Then you are done. Good. Now we ended at the deferred tax. So today I'll quickly explain the deferred tax, then we go through it to finish it up. So the D represent the deferred tax. So much. So putting this together, that is the income tax expense. Taken to where? Profit and loss as the income tax expense. So that becomes the income tax expense. Good. So you are done. Basically, that is how you calculate it. We've gone through this and this. Now we are the deferred tax section. So let's see. Now with the deferred tax, we have to relax. We need two items. Compare their difference. That's all. Here it's a movement. So you can write a movement in deferred tax. Movement in deferred tax. Movement means the difference, the changes up and down. Go. So to get a deferred tax, you have to do a different workings here. We call it deferred tax account or deferred tax workings. So that is it. Good. So assuming that this is the deferred tax workings, this is the deferred tax workings. Underline it. Tell the examiner that it's nothing by what? The open balance. The open balance is always in a trial balance. So bring the open balance here. Now, after recording the open balance, go to the footnotes. The closing balance will be given to you. Relax and pick the closing balance. You come here and then record the closing balance. So much. Now, the difference between the open balance and the closing balance is the deferred tax provision for the year. We are done. In fact, it's a provision, so you can call it provision for deferred tax. And all provisions have the same treatment. Yes. So look at one at what? Provision for bad and doubtful debt. Good. So that's for the same thing. Compare open balance to closing balance. So the movement, then you go to P&L, specifically the income tax expense. So this. If this is positive, don't worry. Have it like that. Come and then put it where? Here. Good. So the movement is what we present here. This. Then the closing balance must go to the financial position. It can be non-current liability or non-current what? assets depending on the type that you are done. So we'll look at it into detail. So that is the end of the game. If you see figure here, that is the open balance. If you see figure, this figure will be given to you in the footnotes. Then you just compare the difference. So that is it. Now let's go into detail what the definition for deferred tax or the explanation. Now, deferred tax, as the name suggests, deferred tax, right? And let's see if it will denote its meaning. Now, sometimes in the accounting period, not all transactions will have tax effect on the same day. Transaction can occur today, but the tax effect is when? Tomorrow. Such a transaction could what we call deferred tax. We are done. Transaction can occur today or yesterday, but the tax effect is when? Tomorrow. How we get the difference? Transaction will take place today or maybe yesterday, but the tax effect will occur when? In the future. So the tax effect is what we mean by what? Deferred tax. Now let's see. So quickly, we are here. We are reporting December 2019. As at this date, transaction transaction occurred before 2019. It can be the same day or previously. Maybe a customer walked to our shop and purchased goods costing 10,000 or valued at 10,000 Ghana cedis and promised that he will pay us at the end of 2020. He will pay at December 2020. You know, the tax authority too, they don't tax on what? Credit. They will tax you when the money is with you so that go and hand over their proportion. They don't want to say about they will tax you and say, oh, the money is not here. I'm not going to chase the people. No. So they tax on what? Cash receipt. So it means that they will wait. When the customer bring the 10,000 in 2020, then they will call you, hello, please bring our portion for us to also take. So as a prudent accountant, we don't need to wait for them to call us in 2020 before we make provision for the tax effect. Let us know our tax rate is just 20%. So that means 20% of 10,000 is what? 2,000. So exactly 2020 December, we are going to pay 2,000 to the tax authority. This 2,000 is what we mean by what? Deferred tax. So now what do we do? Let's bring it in 2019 books. Why? Because the transaction took place in where 2019 and we're supposed to pay the tax in that year. But because the customer said, okay, you pay us future, the tax too, they will take it in future, but let us provide it here. So deferred tax is the tax that we're supposed to pay in future that we are bringing in today's books and defer it later and pay it back to the tax authority. So it's a future tax, bring forward, carry forward again. How we get the concept? Good. So anytime transaction take place here or previously that the tax effect will take future date, it will create what we call deferred tax. That's all. It will create deferred tax. Good. So in simple terms, deferred tax is what? Is the estimated future tax consequence on transactional event which has already occurred, both in what? The current year or what? The previous years. That's all. So that's the deferred tax. Good. Now we've talked about the source of deferred tax. There are two types of profits that as soon as we mention deferred tax, we will explain. We have what we call accounting profit and taxable profit. Accounting profits and taxable profits. Any difference between them? And taxable profits. Taxable what? Profits. Any difference? Accounting profit and taxable profit. Accounting profit is a profit recorded in what? Accounting books by the company using what? The accounting laws. That's the IFRSs. Taxable profit, I call it what? Taxman's profit. It's a profit determined by the tax authorities using what? the relevant tax laws in which the company's income tax liability be calculated on. So the profit that the actual profit that they will charge your tax on is called taxable profit. Now this profit, will they be the same or they will differ, right? Why? What caused the difference? Good. You are using the IFRSs, right? You are using the IFRSs. You are using the what? The local tax laws. So definitely there will be some differences between these two profits. Now the difference, we've named them. One is permanent and one is temporal. You have temporal difference, one, and two, permanent difference. Good. Permanent difference. So the difference between the accounting profits and then the taxable profits can be permanent or can be what? Temporal. Now let me take the permanent difference. With the permanent difference, it's just one off transaction that one person agree, the other person disagree. That's all. One person agree, accountant will agree, tax authority, they say no way that item, we don't agree to it. It will create what we call permanent difference. An example is the donations. Not all donations are allowable. And then a critical example is entertainment. If you're a company and you spend money to entertain either your customers or your employees, end of year party, and include it in your financial statement as a what expense, which will reduce your profit. When you submit this account to the tax authority, say no way, because it's not what necessary. They'll ask you one question. So without the entertainment, they can't work. If you say yes or no, they have to then reverse it back to you. So such an expense, the accountant will include it, tax authority will ignore. So to create what we call permanent what difference, we are done. Now, permanent difference does not create deferred tax. Permanent difference does not what? Create deferred tax. Then what create deferred tax? And let's see. Temporal difference. Now, with the temporal difference, all of them see are the same item. Yes, but the timing is different. The day that this man will see that this one is an asset, the other man will say, no, me have not seen it. So the timing is different. So to create what we call a temporal difference, just given the time, within some few time, it will just pass off. Now, when accountants have a building, can the tax authority see the building as loans? Not at all. All of them see as what? Building. If the company is having a vehicle, can the tax authority see this vehicle as what? A tricycle? No, not at all. It's a vehicle. Just that the value that you place on it or the useful life. In the book, you might say, okay, it will last for let's say 50 years. The tax said, no way. This one, we have to take it off from the book. So it will last, let's say, 2 years or 3 years. Good. And here is the temporal difference that creates deferred tax. Because the value that you have placed on that item different from what the tax authority is also saying. So that creates a temporal difference. So here with the temporal difference, the item, both of them agree due by the timing differences, or both of them agreed but different timing. The year that you are ready to record it, they are not ready. The year that you are ready, the year that they are ready, you have already recorded it in your book. So that's how it happens. For instance, when the customer was owing us 10,000 Ghana cedis, in our book, we are going to record it as what? Owings on our balance sheet, 10,000. The tax authority will not see it as revenue until the customer brings the money. So when the customer brings the money, we've already recorded it as revenue long ago, so you can't record it again as revenue. So the time of it is what different, and it creates what we call deferred tax. So whatever you record in the book, now the tax authority will record it, but not now. To create what we call deferred tax. Good. So that is it. So now temporal difference, finally, is the difference between the carrying amount or the accounting base of assets or liabilities and then what? The tax base. So to explain temporal difference very well, I have to bring two issues up. You have what you call accounting base. accounting what base versus what tax base versus tax base. Now, accounting base, you can also call it what book value. Book value. You can also call it carrying amount. Good. So the difference between carrying amount, book value, or accounting base, and their what? Their tax base. Tax base is how the tax authority also what? Value that item. So you have an asset that in your book, that asset you are saying that the value is 400 million. The tax authority says no way. This value, in fact, is not true. It's supposed to be what? 300 million. So this will create what? Temporal difference. Let's assume that you said this asset will last for 10 years. They are saying no way. This asset must last for just 2 years. Good. So in a 2 years time or 2 years, the asset vanished from the tax authority's records. Due to exactly 10 years, it vanished from your records. So right after 10 years, nobody account for that item. So there's no difference anymore. So the difference will be taken off. That's why the difference is called temporal difference. So this will create a temporal difference, right? So temporal difference is just the difference between what you have recorded in your book and what the tax authority to has also recorded in their book with respect to what the same item. Yes. So here let's record temporal difference here. So if accountant is saying the value is 400, tax authority say the value is also 300. So what will be the temporal difference? That's all. So temporal difference is what? 100. That's all. So temporal difference is the difference between what? What the tax authority is saying and what the book two also what? Saying. Why? Because we are not using the same what? Law or the same rule. So definitely there will be difference. You know the accounting books is subjective. Yes. When they give you chance, you estimate different. But the tax is not like that. The law is fixed. If it is vehicle, charge this rate. Standard. Good. Good. Now, this temporal difference, we are saying that it is the temporal difference that creates the deferred tax. So to get the deferred tax, just relax. Multiply the temporal difference by the tax rate enacted by the government or subsequently enacted by the government. Please, no rumor. No promising of tax rate, no. So that is it. So to get a deferred tax, in short, deferred tax is equal to the temporal difference times the tax rate. That's all. That's the deferred tax. So deferred tax is nothing but what? The temporal difference times what? The deferred tax. Sorry, times the tax rate. That's what? The deferred tax. So here, let's start our example. A customer bought items worth what? 10,000 Ghana cedis. And that customer said that he will pay us exactly 2 years' time. We have recorded it in our book. The customer have not paid the money. So it's a what? It's a receivable. Agreed. Good. So the customer record 10,000 Ghana cedis here. The tax authority, we didn't record it in their book. The customer didn't give us the money. Oh. They have not even seen it at all. So tax authority say no way. The value must be what? Dash until the customer bring what? The money. So this will create a temporal difference of what? 10,000 Ghana cedis. So if I want to calculate the deferred tax on this transaction, so the temporal difference will be what? 10,000 Ghana. So if I want to calculate the deferred tax, I just have to find what? The tax rate. And here the tax rate must be what? the tax rate enacted by the government or subsequently enacted, or the current tax rate or tax rate enacted by the government subsequently. That's all. So basically, that's all about deferred tax. Just that the temporal difference, there are two types. So let's see. Now, if the item in question is an asset, the item that have a different accounting value and different what tax value, if that item is asset, and that's the most situation or most of the exam case, it will be what asset. If the carrying amount or the book value or the accounting base is what greater, more than the tax base, then it will create what we call taxable temporal difference. So it means that small has been subtracted, more is yet to be charged in the future. That's all. Or if you don't want trouble, just tell the examiner that anytime the accounting base is more than the tax base, that temporal difference is called taxable temporal difference. It is what? Taxable. That means in future, the tax authority will call you that please come and pay tax on this value. Good. So if the carrying amount or the accounting base is more than the tax base, the difference is called taxable temporal difference. So let me record it here. Taxable. So we call it taxable temporal difference. Sorry, taxable temporal difference. And taxable means non-current liability. Yes, they are going to tax us in future, so we have a liability, we have something to pay. It's a bad news to us, so let's record it as what? Liability. Now the reverse is the good news. Now if it's an asset and then the current amount or the accounting base is rather lower, maybe here is 700 and here is what? 800. So let's make it 900. Assume that here is what? 900. So it will create what? Difference of 200. We call it deductible temporal difference. Deductible. That means in future, the tax authority will subtract it from our tax. So it's a plus to us. So it will be what? Non-current assets. Non-current what? Assets. So you have to check the item given to you. Which one is what? Higher. So in short, go by this. If it's an asset and the current amount is higher, or the current amount is more, then it's what? Taxable. If the current amount is what? Small, then it's what? Deductible. You are done. All what you've done, the reverse is true for what? A liability. Don't need to worry yourself and then pick all this. The memory might be full. Yes, your memory might be full. So just get the first one. If you change it, it's true for the other. Then you are done. Good. So if you do have any question, kindly let me know before we start the practice, and then we are through with IES 12. Good. So basically, that is it. Now, if you pick a liability, a liability, for instance. Now, if it's an asset and the current amount is more, we call it taxable. If it's a liability, what would be the name? The reverse. Become what? Deductible. Exactly. If assets, the current amount is what? Lower than the tax base, then we call it what? Deductible. What if it's a liability? Becomes what? Taxable. That's all. We are done. So let me write that one also here nicely. So for a liability, if the tax base is what? If the liability and the tax base is greater than the current amount is more than the tax base, we will call it what? We will call it deductible, right? Good. Deductible. But if the carrying amount is rather lower, we call it what? Taxable. Then we are done. So that's the end of this. So I'll project some question and then we will go through it and then you'll be fine. So let's go to success. Let's go to success. So I'll project it and look at it. Then we calculate what? The temporal difference. Then we see. Now, this will just help us to get a closing balance. That's all. The open balance will be given to you in where? The trial balance. If it's not there, it's not there. We cannot estimate our own closing open balance. So let's go to success before finally land on input you. So let's go to success before finally land on input you. So in short, when they give it to you, just find the difference. Don't forget that we can also give you the difference straightforward. We can start a nice story that at the end of the year, the accounting base of some assets or the net asset of the entity exceed the tax base by 100 million. Don't worry yourself and create that. Okay, tax base exceeds, so then the tax accounting base will be 400, then tax base will be 300. No, just use this as what? The temporal difference. Let me take it again. At the end of the reporting period, the net asset of the company or the accounting base of the net asset of the company exceed the tax base by what? 100 million. That's all. That means the temporal difference is what? 100. But they have to tell you which one is higher so that you can know whether it's what? Taxable or deductible. So they say the carrying amount or the accounting base exceed. So that means the carrying base is what? Higher. And that becomes taxable. Good. So we will go to success of the handout updated version. So success limited. Let's go to note 9, last but one. I am interested in the last sentence. Then you start work. I am interested in what? The last sentence. I'm interested in the last sentence. So the last sentence says that, the last sentence says this. The accounting base of some assets was 140 million, whilst their tax base was 130 million. The corporate tax rate is what? 25%. Nicely. So what do? We have to find the temporal difference. Then we do justice. So let's see how best we can do this. So first, all what you have to do is this. You have to tell the examiner that, sir, if you want to get income tax expense for any company, don't worry. First said that relax. Then add three items together. They are C, U, or O, and then the D. But now I'm doing the D, so let me go and do workings. So I'll come here and say that workings within workings. So deferred tax. Online it like this. Sorry. Then I said that the open balance so much. You have to go and look for the figures. Closing balance like this. I'll leave it. So I'll go to the question. We said that the open balance is always in a trial balance. If it's not there, they've not given it to you. So let's go to success. If you see deferred tax or provision for deferred tax, so success, the trial balance. So let's count together. Let me use a search box. Good. So you see deferred tax. Hmm. Deferred tax. So I will scan through, but shouldn't try you. So revenue, cost of sales. I can see tax paid for, and I can see provision for bad. No, I can also see tax provision. That's the only two tax I can see. So no deferred tax. So I'll come here and make it dash. It's not there. I cannot bring my own figure here. No, I can't do that. Now let's go to the footnotes and calculate the closing inventory. They said that I said closing inventory. Yes, closing inventory. Because the popular word that normally match with inventory is what? Closing inventory or closing stock. Okay, so let's calculate the closing balance of the deferred tax. So the closing balance, we said that get two items, find their difference, multiply by the tax rate, you are done. The rest of the story is not yours. You don't need the rest of the story. Get two figures, find their difference, multiply by the tax rate, you are done. If you got the figure is only one, pick that figure, multiply by the tax, you are done. Good. If there are two, find the difference. If there are one, just pick it and multiply. So here, we were told that we were told that um, hmm, for good news, I'm doing a deferred tax section. Great. We're told that the accounting base of some asset was 140 million, and then the tax base is what? 130 million. Tax rate is 25. So what will be the difference? I'll put my bracket. Okay. Temporal difference is what? The 140 million. So here, let's rate three zeros. So 140,000 less what? 130,000. That'll give us 10,000. All times what? 25%. And that'll give us, I like that. So that'll give us, mm-hmm. Okay, so that'll give us 2,500. 2,500. So I record the 2,500 here and relax. Then ask myself, the open balance is zero. What should I do to this zero so that at the end of the day I'll get what? 2,005. Should I subtract 2,005 from the open balance? I subtract 10. No, I have to add to this. What should I do to zero so that I can get to 2,005? Let me add. So I will not subtract, but I'll add. Just put it there and call it what? P&L. Preferably, it's going to a specific section of the P&L. It's going to income tax expense. Then go to the income tax calculation. Deferred tax is here, right? So I'll come and put the 2,500 here. So if I get the other ones, I will call it deferred tax. Good. If I get the current and I'll just add it to it, then we are done. Just like we did that one last week. Don't worry, I'll pick Impuntio to finalize everything. Now let's see. We said that this closing balance can be a non-current asset or non-current what liability, depending on what the nature of what the temporal difference. So if the temporal difference is taxable, it's a non-current what liability. If the temporal difference is what deductible, it's a non-current what, and we call it deferred tax asset. Good. So here will it be taxable or deductible? Taxable, why? Because the asset, good, good. Because the accounting base is what? More than the tax base. So therefore it is what? Taxable, which is what? Non-current liability. So in your financial statement, that's the financial position, the balance sheet, just record 2,500 as what? as deferred tax liability, then you are done. That's the end of the game. Then this is the income tax expense. So income tax expense, good. So that is it. Now let's move on to impuntio. So I'll use impuntio to make final arrangements. The remaining ones are in the lecture video. Now you may be asked to explain why deferred tax, provision for deferred tax is important or the reasons. Yes. So let's go to impuntio. Impuntio is question number 3. Question 2 is 12. Then question 3 is impuntio limited. That's October 2019. Impuntio, that one too, that's note 4. Impuntio, note 3. Yes, note 3. Now let's go to note 3 for impuntio. Note 3. It says this. The corporate tax provided, here we are doing everything. We are starting from CUMD. The corporate tax provided for and paid in 2017 was 2 million, but an amount of 2.5 million has now been agreed as what final assessment for 2017 tax. Corporate tax provision for the year 2018 is 4 million. The accounting base of assets exceed the tax base by what? 4 million. As at the year end, that is 31st December 2018. The corporate tax rate is what? 25%. How do you get it? So you are starting everything. This note is up to income tax. You're going to solve everything about what? The income tax. Good. Now let's see. Income tax. Let's go to the board. Still, the format will not change. The format will not what? Change. All I have to do is just clean and make it empty. I have to make it empty. Clean everything and make it empty. That's all. So I will take it again slowly. If I read a sentence, then I'll analyze and bring it in. Where will it be? That's all. So to get the income tax, this will be the format. This and then this. You are what? Done. Good. Now let's see. So let's take it again slowly. The corporate tax provided for. But before we do that, let's get the year. Which year are you reporting? It's very important. The reporting year. So let's go and get it clear. Reporting for when 31st December 2018. We are doing that because the under or the over will assume immediate date or the previous date. So if I'm reporting for 2018 financial year, if I see any 2017 tax details, it's for what? Under or over. I'm done. Because the current year tax provision, it must bear 2018. How we get it? Good. So that's why the year in question is very important to identify the under or the over. So now let's see. So if they give you tax details for last year, the examiner is just reminding you to do the reconciliation. We call it tax reconciliation between what they provided last year and what was agreed by what? The tax authority. Good. So now let's see. So to get the under or over, we say we compare two items. What you provided in your book versus what the tax authority also what finalize it or agreed on as your final tax assessment. That's all. Then we are done. So let's check from this question. So slowly again. Note 3. Let's go to note 3. Saying that the corporate tax provided for and paid in 2017. The line where is what provided and 2017 is there. So it's for what? previous year. Good. So that's the tax provided. But an amount of 2.5 million has now been agreed as final assessment for 2017 tax liability. So these two figures, one will be what tax provided and one will be what tax agreed. So and all of them bear 2017, which is the immediate year or the previous year. Good. So it will lead to under or over tax provision. Good. So here I can see over who will support me. Okay, now let's see. Now tax provided. So tax provided. They provided for 2 million. That would be 2,000. And then tax agreed will be so 2,500. So will it create over tax provision or under tax provision? So here to create under tax provision, they are provided lesser by the final one. For this one is a final because you don't have the final decision when it comes to tax. Good. So here, if you have not done this in your answer sheet, don't worry. So come here. But here don't write under or over, I'm going to write under again. So here will be what? Under tax provisions. I will call it first before I forgot. Under tax provision. Open my bracket, it is 2,500 less what? 2,000. Then I will also obey. I will also obey. Sorry, I will also obey the rule of what? The three protocols. So I'll come here. The three zeros. So under by what? 500. Please do not do the calculation and throw in the answer 500 here. No, you lose this. These are important. So 1, 2, making what? 3. All of these are for you. But if you calculate them, throw the answer in 2 ticks, you send it home. Left with only 1. And the 2 that you send home, they are more than what? This one. So let's see. So that's the first section. Now let's continue the game. I hope you are not confused. Good. I hope you are not confused. Now let's continue the reading. It says that corporate tax provision for 2018, we are reporting 2018. That's the current year tax or provision. The tax that's provided for the year, the current year. So they have to tell us the current year, the tax that they are going to provide for. So they are saying the corporate tax provision for 2018 is what? 4 million. What makes the current year? Because they've mentioned the year 2018, and we are reporting for what? 2018. So you see the right. So I just have to continue that the corporate tax provision 4 million. So to be what? 4,000. Have you seen that? For the spread zone. Okay. Now let's go to the deferred tax section. The accounting base of assets exceed the tax base by what? 4 million. As at what? 31st December 2018. Corporate tax is what? 25%. So that's the closing balance, right? But he didn't give us the accounting base and then the tax base. What do we do? So they give us what? The temporal difference, right? To be 4 million. So you just have to multiply. Good. So that's the closing balance. So, but before that, we can go and look for the open balance. Come and record it here. Open balance will always be in a trial balance. So let's go to the trial balance and see. In the trial balance, if you see deferred tax, good, or provision for deferred tax. So let's come to the trial balance together. Good. The last item, I can see the last item there. Provision for deferred tax. Let them mention deferred tax to you. Because there are so many types of tax. We have deferred tax, current tax, tax provided, tax paid. Yes. Tax asset, tax liability. So let them tell you this one is what? Deferred tax. Good. But there's another tax too in this trial balance. Yes, before that one you see tax paid for 2018. Tax paid. So there are so many types of taxes. Good. So the figure is, I didn't even record the figure. The figure is what? 400. So that means the open balance is what? 400. And let's see. Open balance 400. Closing balance you have to get by yourself. By opening the bracket nicely. And then the temporal difference is what? 4 million. So that would be 4,000, right? Times 25% agreed. And that will give us 1,000. So if I put 1,000 here, then I'll relax and come back again. Tell the examiner that the difference between the open balance and the closing balance, the closing versus open, the movement, the difference between this figure and this figure, which will be what? 600. So this 600 will go to deferred tax provision. So I'll come here like this and come and write deferred tax 600. If this is workings number, let's say 3, tell the examiner that it should go to workings number 3, to workings within workings. Now we are done. We are done. Now what level is the extract? What level is the extract? Now, let's see. First of all, we sum all this up. That will give us 5,100. So that will go to the income tax expense. Income tax what? Expense. Great. Then we said that the closing balance of the deferred tax is either a non-current asset or non-current liability. So here will it be asset or liability? So this one goes to what? Non-current liability because it's what? Taxable. Agreed. Good. So among your non-current liability, you call this one the deferred tax, 1,000 series. You are done. Good. Then the corporate tax provision, we said that if it is in the footnote, if it's a provision given to you in a footnote, it must be treated how many times? 2 times. And it must go to the current liability. So if you go to the current liability on the balance sheet, just relax and write tax, current year tax provision. So current year tax. But the figure is supposed to be what? Supposed to be 4,000, but just that they pay some taxes within the year. They paid what? In a trial balance. On the trial balance, they pay some tax there. So you less any tax paid during the year. They paid 3,000, and then the under or over tax provision too, they've not paid that one too. So less 3,000 plus 500. Then you put the answer there. So this is how input will look like in the financial position, the balance sheet will look like. So that's all about taxation. We are done with IAS 12. Thank you. IAS 16, you're welcome. So let's switch to IAS 16. These ones are for you. Success. It's yours. That's no, we did success. So it's well for you. And then the recent ones, I think I included some question. There's another one too I added. Let's go to, I think it's the tutorial questions. Tutorial questions. I've added some recently. I've added some questions. Good. Question 5, finish at page 37. Finish hard. Finish hard. Then question 6. Ajinkwa. No, not Ajinkwa. Then the question 4 will be finish hard. Then let's see question 4. Question 4 is we are done. Yes. So question we are done, finish hard, and it's well. You are doing the tax aspect. So now everything about tax, now you can treat that. Good. IA 16. You're welcome. Here to get a full picture, you can still use the video on the IA 16 solely. I think there are 2 to 3 videos on IA 16 that you get a full picture. IAS 16. For the name is called Property, Plant, and what? Equipment. That's the name. PPA. Property, Plant, and Equipment. Property, Plant, and Equipment. That's IA 16. Now, basically, if you pick any standard, we are saying that you should know about 5 items. Item number 1, objectives and scope. Even though no examiner will ask you, but you should know it for your own good. Yes. 2, you should know basic definition. Basic definition. Or some terms. Of some terms. 4, you should know the recognition. 5, you should know the measurement. Okay. Are they 5? I think I'm counting more than that. You should know the measurement. The last one, disclosure requirements. Disclosure. In fact, the important ones are 1, 2, 3. That's all. The rest don't need to know that. Very good. So let's quickly scan through this. Objective of every standard is to prescribe the correct account treatment of that standard. So the objective of, let's say, IAS 80 AMA is to prescribe the correct accounting treatment of what? AMA. That's all. So the objective of IAS 16 will be what? So the objective of IA 16, so long as you know the name, you know the objective, is to prescribe what? The correct accounting treatment of what? PPEs, property, plant, and equipment. No shortcuts. Okay, that is it. Now the scope. It covers all PPEs except those covered in other standards. We are done with the scope. So that's the scope. So these two, don't worry. Now let's see some of the terms stated in this. I just can't choose. You know the definition of PPE. PPE. So I'll list them here and then I'll just touch on them straightforward. And then where there's an issue, just go straight so that we finish on time. But if you want the full picture, the files that are posted on the platform, they contain all the standards. They contain all of them, and then you'll be fine. Good. Now some terms. First, let's look at PPE itself. Definition of PPE. Here I'll define PPE and give some examples. And then some other terms, fair value. In fact, if you want all the terms, I think we can use the ADE video. Yes. Now, property, plants, and equipment. At the conceptual framework section, we look at the assets and we define asset, we give some types. Good. One of them is the PP. So define property, plant, and equipment. Let's see the definition. It's very long. I'll break them into two. One, they are tangible assets. So PPs are what? First, to define PPs, so let's define PP. First, they are what? Tangible assets. So tangible what? Assets. So that's the first tangible assets. So PPs are not intangible. They do have a physical character. Acquired by an entity. So acquired by an entity with an intention not for resale. So that's the first. Not for what? Resale. But for what? But for use in the production of goods and services. But for use in what? Production of goods and services. And for rental, which lasts for more than one accounting period. So they last for what? More than one accounting period. More than one accounting period. So that's PP. Good. That's the definition for PP. Example include the land and buildings, plant and machinery, furniture and fittings, or furniture and fixtures, motor vehicles, computers, machinery. All these are what? PP. We are done. Good. Now I'll go straight forward to the recognition. That's where the issue is. Recognition. So the terms are defined only PP, but the rest they will pop up as and when we move on. Yes, so they will pop up as and when we move on. Good. So let's see. So now go to what? Recognition. That's the important section. Recognition. So recognition of PP. Of PP. Now when you mention recognition, how do you record PP? That's all. How do you record PP in your books? Are they liability or they are expenses? PP. PP. Okay, they are what? Asset. The game didn't work this time around. The game didn't work. Okay, so PPs are what? Assets. You call them as non-current assets. They are non-current assets. To avoid trouble, non-current assets. Agreed. Now, before you can record PP as non-current asset, two conditions must be in place. What are they? And this condition, they must be part of us. You're going to meet the condition about 3 times. Good. Now, condition number 1. Okay, so the cost of the item can be measured reliable, right? Okay, I'll take that. And then the other condition, okay. It must be probable that future economic benefits associated with that PPE will move towards the entity. That's all. So it must be what? Probable that the future economic benefits associated with the asset will flow to the entity. So that's the condition number 1. It must be probable that future economic benefit associated with the PPE will flow to the entity. That is the condition number one. In fact, in exams, if you quote this condition anywhere without the word probable, the examiner have every right to mark you down. Yes. Because accounting, we don't joke with three words. Probable, possible, certain. Yes. So, always very important. B, the cost involved can be measured reliably. So, the cost of that asset. So, the cost of the PPE can be measured reliably. Can be measured reliably. So, self-constructed assets. And sister, thank you. Brother, thank you, PPE should not be recorded in the books. Good. So that is it. Now, probable future economic benefits. Here we are saying that before you can record the asset in your book, make sure that the benefit will move from that asset to you. If the benefit does not flow to you, you don't have an accounting right to record that item as asset. Even if you are the owner of that asset, no. The ownership alone does not guarantee the recognition of an asset. It moves beyond what ownership. That's why we treated was substance over form. And it reminds me right now that there are two outstanding work and a substance over form that I've not received it. Ah, good. So that is it. So anytime you have assets and you are not the one controlling that asset, you cannot record that asset in your book. Good. Now let's go to the cost involved. Anytime you have PPE and then the cost of that PPE, you can't determine it reasonably. Don't put inside the book. So for instance, self-constructed asset, the asset that you construct yourself, sometimes you find it difficult to calculate the cost of that asset because you use the company's resources. You use items of the company to construct that asset. So separating the cost of that asset from the company's cost becomes so difficult. So do not include such assets as well as PPE. These are the two conditions. Now, anytime the examiner asks you, can they record this as an asset in their books? The examiner is just asking indirectly these two items. So tell the examiner that, examiner, relax. If before they can record this particular item as an asset or PPE in their books, two conditions must be fulfilled. Condition number one, it must be probable that this item will bring future or economic benefit to the entity. Condition two, the cost of this item can be measured reliably. Then you come back again, examiner, from the above scenario, even though the benefit will flow to the entity, the cost of this item cannot be measured reliably, and hence no asset should be recorded in your books. You are done. Good. I'm done with the recognition. Now let's go to what? The measurement, and then we are done with IO16. Now the issue has to do with the measurement, not the recognition. Because recognition is just two conditions. If you know them, that's all. Good. Measurement of what? PPE. Let's go to measurement. Then measurement. If you talk or if you mention measurement in financial reporting, for the nickname is what? Value or valuation. Measurement. Value. How you value the item. That's all. So how do you value PPE? There are two types of measurement. We have what? The initial measurement and what? Subsequent measurement. So initial measurement. Initial measurement means if you acquire the PPE today, what will be the value? So initial measurement. Now, we saw this under the IS2 inventory. Inventory, what's the initial measurement of inventory? Good. We said that initially inventory must be measured at what? Cost. Here too the same. Initially, PPE must be measured at what? At cost. So we measure PPE at cost initially. So the initial measurement of PPE is at cost. That's all. So if you acquire PP today, January 2019, what will be the value? And then you are done. You're saying that put the cost, put the cost in, and then you are done. Now, what's cost? This one was explained in the terms. The definition of some terms is in there, but this is where we are going to explain it. If you mention cost or cost of PP, cost of plant, cost of vehicle, it refers to the cash or the cash equivalent that you transfer, or even the fair value of resources transferred. Sometimes you can acquire PP, not necessarily you losing cash. You can exchange your existing asset for a newer one, right? Or for a new version. So like swapping a cycle, your used item, and then you send it, they'll give you. In fact, now if you have old and abandoned what cars, exchange with what land. That means the value of that land becomes what? The value of the abandoned cars. Yes. So that is maybe you have like a school bus, unserviceable school bus, like let's say three of them. Put all of them together. Just go for one piece of land. That's all. So that means that the cost of that land is what? The value of the three vehicles. Good. So in short, cost of an asset is nothing by one, cash, two, but or cash equivalent. So cash what? Equivalent. Or fair value of other resources transferred. Fair value of what? Other resources transferred. Other resources transferred. So you can acquire PP with cash or cash equivalents, or you can also transfer other resources to acquire it. We are done with the cost. Now the issue is this. Anytime you acquire PP, you will incur a whole lot of cost. A whole lot of what? Cost. Plenty. And there are many. Not all of them will qualify, or not all of them to be part of what? The cost, according to IAS 16. Good. So you have what you call component of cost, or the composition, or we call it inclusion. This cost, when you incur it, please add it to the cost of the PPE. Good. So we call it component of what? Cost. So component of cost. It's comprised of three items. So I'll just list them here. First is the purchase cost. Is the purchase cost. Good. Is the purchase cost. Now, when you mention the purchase cost too, there's another one attached to it. But I'll give the details. Purchase cost and then directly attributable cost. So directly attributable cost. And then any other costs incurred necessary to bring the asset to its present location or condition. These three putting together form the composition of cost of PP. Each of them have breakdown. So when I talk about purchase cost, we can also break it down. So purchase cost, for instance, comprised of the purchase price itself, or the listed price, or the quoted price. Add your transportation, handling, or delivering cost to it. The cost that you incur to transport the PP from the point of acquisition to the point of what usage, or to your warehouse or the office premises. Good. So that is it. And then if you pay any tax, or any taxes paid on this acquisition, if you are not going to claim this tax back, then you are allowed to add it. So you add what? Irrecoverable purchase tax. So in short, the purchase costs include what? Let's list them here quickly. So the purchase costs include one, the purchase price itself. Two, it includes what? The transportation cost or handling cost, delivery. Good. And then duties, import duties, right? So duties too is also part of it. Duties is also part of it. Then taxes, but must be irrecoverable purchase taxes. Maybe you paid VAT on the plant that you bought from the supplier. If you know that you're going to claim this VAT back, please don't add it to it. If you know that you are not a VAT registered entity, so for that matter, you cannot claim this VAT, then add it to it. Yes, because no one situation whereby today that item is the cost of PP, tomorrow you are claiming it. Not at all. It must take a fixed position. If you are going to claim it, then take it off, don't add it. If you are not going to claim it, then add it. Less what? Trade discount. That's all. So that's the purchase cost. Less trade discount or similar rebate. Less trade discount or similar rebate. Less trade discount or similar rebate. So it means that this form what? The purchase cost. So this one alone is the purchase cost. Please, it's not compulsory for the examiner to give you all these items. No. It's selection. So we select two here, three there, then we are done. Now we are done with the purchase cost. Now let's go to directly attributable cost. Now we are going to directly attributable cost. Directly attributable cost. Good. These costs, they are the costs that you incurred on the asset before the asset to be ready for it was intended use or intended sale. Good. So that is it. Now it includes what? One, installation cost. So installation. So directly attributable costs, they are the labor and overhead that you work on it. So installation cost is one. Installation, that's a directly attributable cost. Two, site preparation. Site what? Preparation. Three, testing. Pre-production testing. So testing. Then four, professional fees. Professional fees such as what? Legal, architect, surveyor, or consultant used in acquisition of the plant. Some of the PPEs you cannot acquire without a consultant. Other than that, you buy it and they'll come and sack you like land. And then they're going through money to the now the land guys will take over, right? Good. Now let's see. So that's a professional fee. All of them form part of what? The directly attributable cost. So they should form part. Then any other cost. Any other cost. That one we can mention something like this. Any other cost too can mention something like one, dismantle cost, decontamination cost, site restoration cost, environmental pollution. Good. So let's list them. Dismantle cost. And then after we dismantle the item from their site, you have to restore the site. We call it site restoration cost. Then sometimes you create some pollution or you've contaminated the environment or the atmosphere. So the law will usher you to rectify it. They call it decontamination cost. Decontamination cost. Good. Decontamination cost. For these three guys, they are stubborn. So please, I've issued a full video on them. the treatment of the dismantle cost. So to get it fully, all of them are in the list. So by the time you finish the PP videos, one of them will talk about this in detail. They are stubborn. Why? All of these costs, you will incur them future, not today. That makes them stubborn. Dismantle cost, when you dismantle the assets, that's after the end of the asset life. The asset must be removed from the site. Maybe you look at your office plant, yes, where you work. That building, the company does not own it, they are renting it. So after 10 years, they will leave. They'll pack their things and leave. Look at the heavy duty plant that you have installed there. You cast the ground and then lay some concrete. When you are leaving, make sure that you will cast the ground again to remove this heavy duty machine. But the landlord or the owner of the place will tell you that please restore the site back to its initial position. You know this cost upfront. So it's the cost that you will incur it at the end of the asset life. But you have to make provision for at the beginning of the asset life. That makes it what stubborn. Because this cost you are not going to get now. You will get future maybe 10 years time. So at the end of what? Year 10. Good. Just that maybe it will be 50,000 cedis. You say find its value today and add it to the cost of the assets. That is it. So there's a full version on it and then you do justice to it. Okay, so that is the end of the component of cost. Now, once we have the cost that they should be part, definitely you should also have cost that is not from part. We call it what? Exclusion from the cost. So I'll do that one at the other side. So exclusion from the cost of what? PP. Exclusion from the cost. So let's look at the exclusion from the cost. So exclusion from where? The cost of the PP. This cost, when you incur them, do not add it. Exclusion does not mean go and subtract it. No, don't touch it. If the examiner asks you to treat it, then it must go to where? Operating expenses. All the exclusion must go to operating expenses because you are not adding it to the cost of the PPE. So why are you going to treat it? Oh, let me expense it in the P&L. You are done. So exclusion from the cost of the PPE. So the following cost must be excluded from the cost of the PPE. One, general and administrative expenses must be excluded. So general and administrative expenses. So general admin expenses must be excluded. Two, you have to exclude pre-production cost. Pre-production cost must be what? Excluded. Good. Pre-production cost. Then three, initial operating losses. Initial operating losses. Initial operating losses. All this one must be excluded. Now the fourth one, let me explain this and tell me where it will be treated. Assume that you bought a complex office plant or office machine. This machine, none of your employees can use it. None of them. They don't have idea. So you train your staff internally and externally. In fact, when some of them go to outside international training for 5 months, they came back, and now you spend overall $50,000 for the training. So the question is, this $50,000 that you spend for training the staff to use this machine, will it be part of the cost of the machine, or we should expense it in the P&L, or we should exclude it? So we call it staff training cost. So staff training cost must be expense or must be excluded. So staff training cost. Staff training cost. Good. Must be excluded. That's perfect. Staff training cost. Why? Because you are calculating what? Cost of what? PP, not cost of staff. Because this training will just make the staff ready to use what? The machine. It will not make the machine ready to be used. That is it. So you have to include costs that are directly attributable or that will make the machine ready for its intended use. If you like, spend over $100 million and still if the machine is not working, when you return back, the machine is not working. What have we done? Cost 90. You have to go and repair the machine before get ready. So staff training costs must be expense. So all these costs will not be in what? Will not be part of the cost of the DP. You have to expense them. Good. Here too, I have nice illustrations in the handout. So we will just scan through one, then move on to the last aspect of the IA 16. That's where the issue is. So I'll just scan through one of the costs and then you will tell me whether we should include it or exclude it. Then we are done. So let's go to the PPE. Let me see. Now we mentioned pre-production cost. Pre-production cost is like you bought a plant and that plant needs fuel. And we are going to that plant to manufacture, let's say, books. So that can be bought some of the raw materials, A4, so that when they come, like you start the production. This cost, this small cost, do not add it to the cost of the plant. So they are pre-production or cost. How do you get it? Good. So that is it. It's like, let's say this example. We're in Ghana where we had some terrible accident on the Kintampo Road where two cars got bent, right? As a result of pre-production cost. Now the issue is this, someone bought motor from Accra to Tamale and bought fuel in addition. And all these two were in the same bus for transport and catch fire. That's why the book bent very well. So that is it. So sorry about that. Good. Now also, I said initial operating losses. Now some of the assets they will tell you that please at the first 72 hours you may incur some losses until the asset reach its what maximum capacity. So initial stage of every asset, you might not see it well, it may print not too well. In fact, if you buy a printer initially, like it become faint unless you start using it and then you see it will pick up slowly. So at the initial stage, any losses that this asset gives you, don't add it to the cost of the asset. Expense in the P&L. How do you get it? So that's the initial operating losses. Good. Now let's pick this question. I hope you have the handout on the standards. If you don't have it, then let me know. The standard on the handout on the standard, right? Good. Or the lecture material. If you don't have it, can you let me know? So I'll upload it on the platform. I think I've not uploaded the second one, the IA 16. The first one contains only IAS 2, 8, 10, and 12. Good. So let's go and pick this one, the standards. So if you don't have the handout, can you let me know so that I'll forward it to you? Or you can also the can also request for the hard copy. You can also request for the hard copy. All the same, they are supporting videos too available. So this one, I'm just scanning. So I'm scanning through IA 16 today. So I'm scanning through IA 16 today. Scanning through IA 16 today. So please don't have it. Kindly get it for me. So this one contains 16, 20, 23, and 40. In fact, I left one out. IS 40 must be part. Yes, IS 40. So I'm trying to see if you can do a bit of IS 40. All of them, they are there. In fact, if you can agree with me. Okay, now let's go to tutorial question one, example one. Good, example one, that's page 9. Example one, page 9. Required. What is the cost of the asset to be initially recorded or recognized in the PP register? So the cost of the asset to be recognized in the PP register. Now let's go to the question. You have just been appointed as the financial accountant of Asuna Company. Stop. On January 2014, Asuna Company acquired a production equipment with a list price 250,000. So the list price is what? The quoted price, which is what? The purchase what? Price. Good. The following further costs were incurred. Delivery 18,000 cedis. Installation 24,000. General and administrative cost of indirect nature 3,000. So now let's see. Let me start from the 250,000. Will it be parts? That's the purchase price, right? So the 250 will be parts. Okay. Let's go straight. As and when you inform me, I'll just be included. And then we are done. So here first, the cost of that equipment will be, so I record right here, cost of the special equipment. First, I'll put Ghana cedi here. They say list price, right? Or the listed price. This is 250,000. Good. Now let's move on to the next one. The next item in question is what? Delivery cost 18,000. Will it be part? So delivery will be part. So delivery will be part. That's 18,000. Good. Then installation cost will be what? Will be part. So installation 24,000. Then the next one, general administration cost of indirect nature. Will it be part? Okay, what if it is direct nature? Admin cost. Admin cost. So what? So admin cost should not be part. General administrative cost should not be part. So 3,000 out. So where are you going to treat it? Where will it be? Good, operating expenses. Cost, admin cost, you add to operating expenses. So that 3,000 goes to operating expense. Now, look at this. Now, the requirement is very critical and important. We can ask you to account for the above. If we ask you to account for the above, then tell us where you treat each and every transaction. Good. So now you have to tell me where the admin cost will go. If you don't tell me, you lose marks. But if I ask you that calculate the cost of the PPE for me, after getting the cost, that's the end. The other stuff, that one does not come in. So check the requirement carefully, whether you are required to account for the above or just a particular section that you are looking for. How do you get it? Great. Now let's continue the game. The installation and setting up took 3 months, and a further amount of 21,000 was spent on costs directly related to bringing the asset to its working condition. Should they add it? Hmm. Installation and setting up took 3 months, and a further amount of 21,000 cedis was spent on costs directly related to bringing the asset to its working condition. Yes, so to be part. So we call it additional cost incurred. So this additional installation cost of 21,000 will be part. Now let's continue the game. Monthly, in fact, there was one line I've missed it out. The equipment was ready for use on 1st April 2014. This one is when you're calculating depreciation. For now, we will not need this. So you're calculating cost of what? The equipment. Monthly managerial report indicated that for the first 5 months, the production unit from this equipment resulted in an initial operating losses. So operating loss of 15,000 because of small quantities produced. Small quantities produced. The month thereafter show much more positive results. Should we add it? 15,000 loss. Will it be part of the cost? That is what initial operating what losses must be ignored from the cost of the PP. That must be accounted for in what operating cost. Good. The equipment was the equipment has an estimated useful life of 10 years, an estimated residual value of what 18,000. Estimated dismantle cost amounting to what 12,000. Will it be part? Dismantle cost. Good. And that cost. So I'll come here and write dismantle cost 12,000. So I'll put this cost together. Whatever I get, that's the cost of the PP initially. That's the total cost of that PP. Then we are done. So that's the end of the game. That is the end of the cost of PP, basically. Good. This one came in the year that Impuntio came. It was together with Impuntio. So that year is October 2019. So I will project the question and add it to the drops. Please, the drops, I hope you have seen it. The drops, yes. Just that I don't question to just that one I'll scan through. I'll scan through the next question. So the next question says Donfor Limited. Donfor Limited is installing a new plant at its production facility. It has incurred this cost. One, cost of the plant. So cost per supplier's invoice plus what? Taxes. 2.5 million. Will it be part? Yes, that's the purchase what? Price. Good. Initial delivery and handling cost. 200,000. Will it be part? Good. Cost of site preparation. Will it be part? Good. Consultant used for advice on the acquisition of the plan. Will it be part? Consultant. That's what? Professional fee. Legal, architect, lawyers. That's all. Wait. Okay. 5. Interest charges paid toward supplier of plant for deferred credit. Will it be part? Not be part, right? Good. But this will not be part. So all the items above will be part except this. So except the 200,000, the interest charge paid to the supplier of the plant for deferred credits, no, not be part. Why? Because This is the payment. You get the item, just that you file the payment into future date and the supplier charges some interest or penalty on it. So that should not form part of the cost of the plant. Now the sixth one, estimated dismantle cost will it be bad to be incurred after 7 years. Good. Now please use the full section to get the full treatment of dismantle costs. I did that. Because the dismantle cost, you have to give you the cost of capital for you to find the present value. It's a cost at the same time a liability. Yes. And then there's a full section on that. Good. So dismantle cost run will be part. Operating losses before commercial production will be bad. Good. So you ignore. So that's the cost. Great. That's the end. Now let me come to the last one, making three. Then we are done with the initial measurement. Then I'll go to what the subsequent measurement to end the game. Good. But IS system is a very long standard. They have a lot of issues. A lot of issues. So I'm highly certain that this time around too, you are going to meet IS 16. But every system, IS system must be there. You can't do it with IS 16. Yes. But definitely, there will be PPEs in the question. And the PPEs are covered in what? IS 16. Good. So let's go to the tutorial questions. Tutorial question, I think question 7 or so. Okay. Huh? Okay, I think. Okay, so let's go to question 12. Illustration 12. That's page 16. We do have the material. Good. This is ICA past question. When I'm done, I think we'll try your own too. Yes. Now you try your own. Good. Now, illustration 12. On January 1st, 2012, Samanpa Company acquired machine under the following terms. Manufacturer's base price 1,050,000 cedis. Trade discount applied to the base price only 20%. Early settlement discount to be taken. Now, this discount you only apply the trade discount, not what, not the settlement discount. So yeah, that one goes to the P&L. So that one will not be part of the cost of the PP. We said that less trade discount, right? So any trade discount must be subtracted, not the cash discount. There are two types of discount. We have the trade discount. That one they will give it to you when you buy more for bulk purchases. Buy three and get one for free. That's a trade discount. And then we have the cash discount. Pay now and let me do the price for you. Or pay later and pay the full amount. That's what settlement discount. We are not talking about settlement discount here. So settlement discount should not be part, must be excluded. So this 5% will not be taken into consideration. However, the 20% will be taken into consideration because that one's trade discount rate. The next item. Freight charges, 30,000 will be part. Freight charges, yes, it will be part, right? That's a delivery. Good. Electrical installation cost, will it be part? Electrical installation, good, it will be part. What about staff training in use of the machine? Good, I like that. Pre-production testing will be part. Pre-production testing. Okay, I like that. In fact, that one was pre-production cost. This one is pre-production testing, and testing is part. Testing of the machine is part. Good. Just that here they are saying pre-production testing. So before you use the machine for the first time, you have to test it. Good. So it will be what? Part. But the item that we said will not be part will be what? Pre-production cost. Good. So have you seen how we can be changing the words much more? Good. What about purchase of 3-year maintenance contract? Will be part maintenance. Maintenance contract. No, it not be part. To go to the P&L, repairs and maintenance on that machine. So we are done. So I'm done with the initial measurement. Now let's go to the subsequent measurement and then we are done for the game. This is where the issue is. This is where the issue is. Subsequent measurement. There are 3 types of measurement. Initial and what? Subsequent. Let's look at the subsequent. Subsequent measurement. Good. Subsequent measurement. Subsequent measurement. Subsequent measurement. Good. Now, what do you mean by subsequent measurement? The issue is this. If you acquire the asset, maybe first time you acquire the assets, the value to place on that asset is called initial measurement, right? Then the next reporting period, maybe December, what will be the value will you place on the same assets? And then the next reporting period as well. And the subsequent until the asset is disposed of from your books. So subsequent measurement simple means measurement after the initial what recognition or the initial measurement. That's what I mean by what subsequent measurement. Good. So basically that is it. So subsequently, here relax. There are 2 models. The entity have to choose between what? One. So that is it. So for the subsequent measurement, you have to select one, choose between 2 models. We have what we call the cost model and what? The revaluation model. All of this, they are looking for one item. What are they? They're looking for the item that to be placed, or sorry, the value that to be placed on that plant or the PPE. We call it carrying amount. So carrying what? Amount. All of them, they are just giving us a formula or how we can what? Arrive at what? At the carrying amount. That is it. So basically, that is it. All of these 2 formulas. So you see select one, you can't select the 2 at a time. No. Either use the cost model or the revaluation model. That's all. All of them is looking for what? Carrying amount. The value that you have to place or include in the financial statement in respect of that particular PP. That is the carrying amount. So what's the carrying amount of item that they bought initially is at cost. So the carrying value is at cost. Good. Now the cost model is saying that, so let's treat the cost model first. So we are treating the cost model. The cost model says that relax. If you want to get the carrying amount, let me start writing it from here. Start to go there. If you want to get the carrying amount, relax. Relax. All what you have to do is get the cost of the asset, less accumulated depreciation, less accumulated impairment loss. Accumulated what? Impairment loss. Good. Less accumulated impairment loss. But I'm writing depreciation again. Accumulated impairment loss. Accumulated impairment loss. Good. So that's what the cost model is saying, that if you want to get the current amount of the assets, relax. Bring the cost of the assets, less any accumulated depreciation, less any accumulated impairment loss. Now over here, he said that there's a section. I mean, this impairment is being governed by the IAS 36. So IAS 36 talks about the impairments. So normally we wait when we get there, then we look at it. So it means that in calculation, it just costs less what accumulated depreciation. Cost less what accumulated depreciation. But if they ask you to tell us or ask you to come out with the treatment, don't forget to tell the examiner that. Don't forget that you add all. So that is it. Now you know cost. This cost is the one that we've looked at it recently or just now. So what we have to look out for is the accumulated depreciation and how to calculate depreciations, and then we are done. Good. Now let's see. So depreciation. I will go straight to the point. Depreciation. So depreciation. So let's see for depreciation. Now depreciation is just a fall in value of assets. So fall in value of what? Assets. So that's the depreciation. That is the depreciation. All what you have to know is the methods. How do we charge depreciation? And then the factors and some courses. These ones are, how do you call it? Textbook knowledge or coming from the level one. Good. Now, what we have to look out for, firstly, is the method of charging depreciation. We said that this PP that you've acquired subsequent to their initial measurement, or after the initial measurement, their value will start what? Dropping down. How do you account for any fall in value? That's all. So depreciation is what? Fall in value of an asset. Or we are saying that is a systematic allocation of the depreciable amount over the asset's useful life. Good. So first, what we do is this. We look at the method. So methods of what? Depreciation. Then we are done. So we are going straight. In fact, there are 5 methods. You should know only 2 or maximum of 3. So 5 methods. So in each of the methods, we should know how to calculate what? Depreciation. In each of the methods, you should know how to calculate depreciation. Good. So method 1, straight line. The line is straight. So straight line method and the reducing balance method. And then we have sum of years against. Then we have the fourth and the fifth, they are just a remix of the straight line. So you don't need to worry about it much. Good. But these first 3 are okay. These first 3. In fact, I only do the first 2. Then we are done. How to calculate depreciation on the first 2. Yeah, I'll go straight forward using the final account preparation. I'll use the final account. How to calculate depreciation. Yes. Straight line, the depreciation, the formula will be, so I'll start with a straight line and go straight because of our time. I'll use the final account. Yet, if you want to get a full picture, everything has been done. So everything is in the material. Yes, good. Now we say depreciation is equal to cost of the asset less the estimated residual value. Residual value all divided by the estimated useful life. Good. So this will be the formula for calculating depreciation. So the cost of the assets less estimated residual value all divided by estimated useful life. That is the cost of calculating depreciation, basically. Good. Now you can also be given the useful life as in the form of what rate or percentage. That one you multiply. So that one become the cost less the residual value times what? The rate. So when they give you rate, you multiply. When they give you years, you do what? You divide. That's all for calculation of the depreciation. Now let's see. Let's back it with what? Illustration. So my usual example, assuming that the cost of the asset, I'm going straight for it. The cost of the asset is 35,000. The scrap value, the residual value is also called the scrap value, 3,000. And then the number of years, maybe 4 years, or the rate will be 25%. Calculate the depreciation per year for me. The depreciation per year. The depreciation per year will be good. So the depreciation per year, we said that is the cost of the asset less any scrap value or divided by the useful life. Good. So over here you have 35,000, but let me sit here like this. Good. So depreciation will be cost of the asset 35,000 less the scrap value of what 3,000 or divided by 4 years. Then you are done. Or you can also tell the examiner that is 35,000 less 3,000 times 25%. If they give you rate, you multiply. They give you the years, you divide. And all of this will give us 8,000, right? Go. So basically, this is how you're going to calculate depreciation using the straight line method. And then what will be the accounting treatment of this depreciation? Before we go to, in fact, I'll look for a question, then we will try it. Then we go to the reducing balance. After the reducing balance, then look for the treatment. Then we are done with what? The cost model. So we see if we can tackle the revaluation model. But IS 16 it's a very long journey. Yes. So I will probably humbly. So let's go to Impuntio. Let's go to Impuntio. Impuntio. One of the notes. Let's go to Impuntio question 3. Impuntio. Let's go to note 7. Note 7. Input your note 7. Note 7 states that note 7 states that the depreciation policy is to depreciate all non-current assets at the rate of 20% on straight line basis. So for straight line, it's just the rate multiplying by what the cost less what the square value. The cost less square value is called the depreciable amount. The amount that will suffer what for depreciation. Good. So now let's go to the trial balance and go and bring the assets and start depreciating them. So when you go to the trial balance, you can see that you have furnitures and fittings. If there are no other notes, then the depreciation will be 20% on that value. Here there's no scrap value. There's no what scrap value. So if there's no scrap value, it's not given. We cannot estimate it by ourselves. No. So now it's just the cost times what the rate. So if there are no other notes in the books, then the depreciation on the furniture and fittings will be 120,000 times 20%, and that will give us 24,000. Agreed. Now let's go to the next asset. The next asset is the next one. I have motor vehicles, right? Motor vehicles. No, the value of motor vehicle. The motor vehicles are here. The motor vehicles 120,000. The 50,000 is the provision for depreciation. That's accumulated depreciation. Okay. So therefore, the motor vehicles, their cost is what? 120,000. Their cost is 120,000. That one to 20% on it. Good. That is it. And that will give us 24,000. Perfect. Now let's go to equipment. Have you seen that the equipment they've given us cost of 45 in the bracket, right? Good. So therefore 20% on that 45 million will give us something like that's 9 million, right? Yes, that'll give us 9 million. So these are the depreciation. If there are no other issues in the question, this will be the depreciation. And you are done. How to calculate the depreciation if there are no other issues. Yes, but definitely there will be other issues affecting them. Good. So basically, that is the calculation of the depreciation using what? Straight line method. Now let's go to the method 2 using the reducing balance method. Method 2 using reducing balance method. Now for reducing balance method, depreciation is charged on the net book value or is charged on the carrying amount. Is charged on the carrying amount. Now with the straight line method, instead there is a method of charging depreciation where equal or constant amount is charged as depreciation over the asset's useful life. Agreed. Good. So that is it. Now with the reducing balance, not like that. Reducing balance. As the name suggests, reducing balance. Here, you charge higher amount of depreciation at the initial stage of the asset life. As the years goes ahead, you reduce the depreciation that you are charging. Good. Here, the asset value reduces at what? At a reducing rate. But for the straight line, the asset value reduces at a constant rate. Good. So basically, that is it. Here, the depreciation per year will be the cost of the asset less what? Any accumulated depreciation charge. Now you multiply by what? The rate. You are done. That's all. So for depreciation on reducing balance method, pick the cost, relax, subtract any accumulated depreciation charge on the asset from it. You are done. So that is the reducing balance method. Here, as the years are going ahead, the depreciation value must also be reduced. So the asset value reduces at what? At a reducing rate. Good. And then you are done. Now let's see. The same example that we said, cost of the asset is still 35,000. I've not changed it. Scrap value is still 3,000. I've not changed it. The rate, here we need a rate, 25%. So for year one, I'll do for 3 years. So for year one, depreciation will be the cost of the asset is what? 35,000. What is the accumulated depreciation for year one? Zero, because no charge any depreciation. This is our first time charging depreciation. Our first time charging depreciation times the rate of what? 25%. And that'll give us 8750. That's the depreciation for the first year. Good. When you go to year two, what do? When you go to year two, depreciation will be what? 35,000 less any depreciation charge on this asset. So they've charged you what? 8750. Now times what? 25%. And that'll give us good. 6563. Good. So that is the 6562.5. And we run it towards 6563. Good. Now can you try year three for me? Let's see year three. Year three. So year three too, tell the examiner that depreciation will be 35,000 less. Now here we sum up the accumulated depreciation. Total depreciation charge on the asset so far. So far they have charged 8750 plus 6563. That'll give us 15,313. Now times 25% is the addition of these two. So far depreciation charge, then you take it off. That's the reducing balance method. As the years goes ahead, subtract any depreciation charge before you charge any new depreciation. You are done. And this one give us what? 4,922. If my calculator would be right. 4,922. Now when you go to the last year, if you are sure that that's the last year, relax. Don't worry yourself to do any computation. If year four, it happens to be the last year, have you seen that there's a scrap value of 3,000? You've not used it. So why are you going to use it? It's the last year for reducing balance method. It's the last year. Now, the last year, when you get there, what you have to do is this. You get the carrying amount. After getting the carrying amount, if there's any scrap value, less it. The remaining balance is the depreciation. You don't multiply by any percentage. So here too, I'll get the carrying amount first, which is what? Or I'll get the net book value. Less all depreciation charge so far. I'll add 1, 2, 3 together, or just add 4922 plus what? 15,313. So the depreciation alone will give us 20,000. 20,000 35. 20,035. 20,000. Fact 20,000. Is it 225? Good. Can you confirm this plus this? 20,235. 15,313 plus 492222. Okay. Now, when you go to the last year, bring the cost of the asset less all the depreciation charge on the asset. If there's any scrap value, less it. Whatever remains, so let's less the scrap value. 3,000. This is the scrap value. Whatever remain is what? The depreciation. No percentage. The last year. No percentage. So left with what? 11,765 or 675. Fact 11,675 like it, right?
No, 765.
Okay, so 765. We are done with the reducing balance method. How to calculate depreciation on reducing balance method. Basically, how to calculate depreciation on reducing balance method. Good. Now let's backward what with the illustration. Let's go to success. We can still get some there. So let's go to success. Now after success calculation, they'll look at the accounting treatment. How do you treat it? After knowing how to calculate it, second, how you are going to treat it in the books. So that's the calculation. Now in exams, these two figures will be the trial balance. At any point in time, they'll give you the cost separately. They'll give you the accumulated depreciation separately so that you can now pick the two, find their difference, and charge depreciation on. So in a trial balance, expect the examiner to inform you or give you the cost and give you what? The accumulated depreciation in the trial balance. Good. Now let's go to success. For input to all the assets were on straight line. So success. Success, the plant was on reducing balance also. Success, which of the notes? Good. Note 4, the last sentence in note 4. Success, note 4, the last sentence, note 4. It says that the plant and equipment is being depreciated at 20% per annum using what? Reducing balance basis or method. Using reducing balance or basis. So all what you have to do is you go to the trial balance. Let's go to the trial balance. Any asset that you pick, get it what? Its accumulated depreciation and take it off. Its accumulated depreciation and take it off. Good. So this relates to the plant and equipment, right? So good. So you have to take it from the plant and equipment. Good. So it's only the plant. So let's go to the plant and equipment. The plant and equipment, the cost is what? 60,000, right? Yes, the cost is 60,000. Great. The cost is 60,000. Now the accumulated depreciation is 20,000. So depreciation is at the rate of 20%. If there are no other notes, then how do you calculate depreciation for that of the plant? Good. How do you calculate depreciation for the plant? So that will be good. So that will give us 60,000 less 20,000, right? That will give us 40,000 times what? 20%. So that's the depreciation for success if there's no other note. Until other note comes in, that's how the depreciation will be calculated. How we get it? So this 60 less what? The 20,000, that's the accumulated depreciation. Good. Now let's go to it well. Question 2, it well. So we're calculating all the depreciation and to further what? Note. It well. That's question 2. That one the examiner took his time to inform on the depreciation policy. So depreciation is to be provided as follows. Asset, basis, they are the building, C note 3 below. Plant, 12.5% on what? So let's go to plant. Yes. So plant on the trial balance, where are you? Plant and equipment, note 2. So the cost is what? 36,000. Agreed. Is there any accumulated depreciation? Which is what? 5,600. Agreed. So what do you do? So you subtract this 5,600 from where? The 36,000. Whatever remains is what? 12.5%. And that's what? The calculation of the depreciation. So for success, it will be something like this for success. So for success, all what you have to do is relax. What is the cost of the plant? So depreciation for success, open your bracket, it will be 36,000 less any accumulated depreciation 5,600 times 12.5%. You are done. Whatever answer you get, that's the depreciation. Now we are done with the calculation. We are done with what? The calculation. Now let's go to the accounting treatment to end. How do you treat depreciation after you've calculated it? After the calculation, where are you going to treat the depreciation? It's very important. Now we know how to calculate the depreciation at various levels in the financial statement. The next one is to look at the treatment. Where will it go? Will it be in the P&L or the financial position? First, depreciation is an expense. So first, depreciation is an expense. So it must be expense in the P&L. Where specifically? Now, if it have two places, it's strange. Sometimes it can be part of the operating cost, sometimes it can be part of the cost of sales. And they will inform you. If they don't inform you, you can treat it as what? Operating cost or cost of sales. Any of them is correct. Good. So first, depreciation, accounting treatment. Two treatment. Treatment number one, add it to either cost of sales, or the operating cost. Cost of sales or operating cost. Cost of sales or operating cost. Good. Sometimes they'll inform you where to treat it. Now let's go to Impuntio. Let's go to Impuntio though. And then success, and it will all of them were told where to treat the depreciation. So Impuntio, for instance, if you go to great, let's see the one which is ready. Go, let's go to it well. So all depreciation is charged to what? cost of sales. So depreciation subtract cost of sales. That's it. Well, that's note 2. It's well, question 2, note 2. Beneath it is there. Good. Now the issue is this: if that plant is used in production, the depreciation of that plant must be part of the cost of sales. But if that plant is used in administrative work, then the part of what? Admin cost. Simple. Just that when we are starting the question, you are not there. We didn't tell that this plant is admin, or this PPE is coming from admin, or this PPE is at the production department. No. And so that's why the examiner must inform us what we should account for the depreciation. Good. So that is it. That's one leg. Leg number 2. Second leg, depreciation, accounting treatment. This the first leg. Leg 2, add it to the accumulated depreciation and subtract it from the cost of the asset. That's all. Add it to what? The accumulated depreciation before you subtract it from where? The cost of the asset. So add it to the accumulated depreciation and subtract the whole answer from the and subtract the whole answer from the cost. And subtract the total from the cost of the asset. So on the PPE schedule, we did some PPE schedule, the workings that we did on the PPE. We brought cost of the assets and it was accumulated depreciation, right? So before you subtract that accumulated depreciation, kindly add this depreciation to it first. So I'll use this question as a trial. This was the accumulated depreciation given to us on the trial balance. This is the cost of the assets. Now, what's the depreciation charge? What will be the answer? So the depreciation charge like this will be, that's 36,000 less 5,600 times 12.5. That'll give us, okay, so let's see, 3648 like this. Good. So when you go to your P&L, add this figure to the cost of sales or your operating costs. You are done. Yeah.
And then 10.5.
Okay. So 3,800. Yes. That's why I was looking to the sky. But I've searched and searched and searched. It was not coming. Good. So 3,800. So therefore, what's the accounting treatment? First, add this figure to cost of sales or operating costs. Second, add it to the accumulated depreciation and subtract it from where? The cost of the asset. So in the PPE schedule, which session can I do? Okay, let me check. In the PPE schedule, sorry, I'll take this session. Assume that this is our PPE schedule nicely, like this. You go to the cost section, you wrote the assets and you wrote costs of the assets. You wrote costs accumulated what? Depreciation. And you wrote carrying amount or net book value. So maybe this one is plant. So I record here plant. The cost is 36,000. Now the accumulated depreciation that they have, it was 5,000. So they say add to the accumulated depreciation. I've added to what? This figure. So when I add these two together, what will be the answer? Then I'll treat it in the books. 5,600.
9,400.
Good. So I'll put a 9,400 here. I'll take it off. So this goes to the PPE schedule. So that's how you treat it. So you add this treatment, add the accumulated depreciation to the cost. As soon as I'm done with the PPE IS 16, I'll give you a comprehensive format for the. We will change from this approach to a very comprehensive one, and then we are done. So we are done with the treatment of depreciation and how to calculate with what depreciation. What level is what? You have to back with what illustration and more questions. Good. Just that, unfortunate for us, this is how far the good Lord will bring us. Yes. On that note, we will end here and continue the other time.